All right, sorry, I was hoping to be back today, but unfortunately, the baby's having some minor issues and is still in the hospital. So I'm going to be out today and hopefully I'm back super soon. But thanks for your cooperation with Miss Cook while I'm out. I really, really appreciate it. And, it's important that we keep moving along in the class. We have a lot of material to cover over the course of the semester. So I'm going to make this video to kind of simulate how class would look if I was there. Miss Cook, distinguished accountant, can, help you along the way. All right, here we go. So first transaction here, a company receives $15,000 cash in advance for work to be performed over the next year. What is the journal entry to record this? All right, I'm going to go ahead and pause it right now, give you a second. All right, so the correct answer here is a debit to cash and a credit to unearned revenue. Remember, we are receiving cash, but we haven't done any work yet. And so because of the revenue recognition principle, we cannot count that as revenue. Remember, unearned revenue is a liability. So as liabilities increase, they get credited. Second question, within the same problem here. At the end of the year, half of that work related to the to the $15,000 cash received in advance is now performed. So what would the adjusting entry be? All right, and so remember this chapter we're learning three things. One is adjusting entries, two is depreciation, and three is closing entries. So this first one is not an adjusting entry, but the second one is an adjusting entry, meaning we are making an adjustment at the end of the month to update our books as to how much of an expense that we've used or how much of revenue that we've earned. I'm going to pause. Okay. So the correct journal entry here is a debit to unearned revenue for $7,500 and then a credit to revenue for $7,500. If you were to look at it from a T accounts perspective, this $15,000 represents the October 1st journal entry, and debiting it is subtracting from that $15,000. By the end of the year, we don't have $15,000 worth of unearned revenue. We have $7,500 worth of unearned revenue. And in order to get from $15,000 to $75,000, we need to debit it, which that is a subtraction because it's a liability. So a debit to a liability is a subtraction. Next question. So this is an adjusting entry. Salaries of $7,500 are earned by workers this period, but not paid as of December 31st and will be paid in the following year. And so remember, because of the matching principle, which tells us that regardless of when we make cash payments or receive cash payments, we need to recognize the expense during the period in which they're incurred. And so because they worked in 2020, we need to have that $7,500 worth of expense in 2020. All right, I'm going to go ahead and pause there. Take a second, write down a journal entry. Okay, so the correct journal entry is a debit to salaries expense and a credit to salaries payable. That way we are correctly putting the expense during the year in which it is incurred, and then we're putting on our books that we owe $7,500 for salaries that have not yet been paid. So then on January 7th, we pay salaries of $15,000. So it looks like, $7,500 was from 2020, and then an additional $7,500 representing the amount of work done from January 1st to January 7th was done in 2021. I'm going to pause here. Okay, so this is a little tricky. This debit to salaries expense, once again, represents the amount of work done in 2021. This debit to salaries payable represents that we no longer have this liability because we paid $15,000 in cash. So we're closing out the liability we created back in 2020. We're recognizing the expense of the work done in 2021. And then obviously we're crediting cash because we sent out a bunch of paychecks. And so we have less cash in our account because we paid our employees. All right, December 31st. Depreciation on the company's equipment for 2020 is $17,251. Record the adjusting entry for the end of the year. I'm going to pause. Okay, so this is a debit to depreciation expense and a credit to accumulated depreciation. I know we talked a little bit about this last chapter. This is probably still a little bit unfamiliar to you. Accumulated depreciation is what we call a contra asset account. Contra meaning against. It's a subtraction from whatever asset that it is attached to. In this case, it's equipment. Ms. Cook, I'll let her explain a little bit more about the net, how that relates to the net book value. So I'm going to pause for a second, let her explain that. All right. These are kind of annoying, tricky. And for me doing this, the best way to do it is to set up a T account. It helps make sure that I don't make any mistakes. You just got to be careful. You got to read these questions super carefully. The supplies account had a debit balance on December 31st, basically the end of last year of $240. And then during this year, we purchased 6,102 more of supplies. And then when they did inventory on supplies at the end of the year, they had 660 left over. So they started with 240, bought 6,102, had 660 left over. So the question is, how much did they use up during the course of the year? And so, like I said, the best way to look at this to avoid mistakes is to set up a T account. So you could see here the $240 is the beginning balance. They purchased 6,102, and then they had 660 left over. And so, if you understand that supplies is an asset, this is a positive, that buying more is an additional positive, and that the normal balance always ends on the positives, on the debit side. All right, so like a quick equation to calculate this would be 240 plus 6,102 minus X equals 660. And so when you solve for X, you would get 5,682. And so the journal entry here is confusing. You have two accounts, both have the word supplies in them. One is an expense and one is the asset. So it's a debit to supplies expense and a credit to supplies. So remember, supplies, just like most other assets, are assets until they get used, in which case they become an expense, right? In the last problem, this equipment, over time, it becomes an expense. It just depends how long the life of that equipment is, but over time it gets depreciated, and that asset slowly, over time, turns into expense over its useful life. And it's the same thing here. Supplies is an asset until it gets used, and then it becomes an expense of the company. Okay. So a company spent $150,000 on prepaid insurance to cover them for the next year. We covered prepaid insurance a lot. You should know that that's an asset. So I'm going to pause here, let you do the journal entry. So the correct journal entry here is a debit to prepaid insurance and a credit to cash. Two assets, right? So on the same side of the accounting equation. My prepaid insurance asset was increased with a debit to $150,000, and the other asset, cash, is decreased by a credit of $150,000. So then the next question is, at the end of this month, so 1 month has gone by, so we've used up 1 month of insurance. What is the adjusting entry to reflect the amount of insurance that we've used? Pause. Okay. So like I talked about in the last problem, assets become expenses over time. We do not have $150,000 worth of prepaid insurance anymore. We had $150,000 worth of prepaid insurance at the beginning of the year, but 1 month has gone by. So we've used up 1/12 of that. All right. And so 1/12 of 150,000 is 12,500. So how do we subtract from an asset? We credit it, and then you debit insurance expense. Okay. New concept here. This is recognizing interest that we've earned but haven't yet recorded because we haven't received the cash yet. So we have to do an adjusting entry for it. So the company has earned but not recorded $1,400 of interest from investments for the time period December 10th through December 31st. The cash is going to be received next year. Record the adjusting entry for 12/31/20. Pause. Okay. So a couple new accounts here. First one is interest receivable, which is the exact same thing as accounts receivable in terms of it's a debit. It's money that we are going to receive in the future. It has a lot of the same principles. It's just a little bit more specific. It has a little bit more specific name so that people can identify, okay, instead of it being an accounts receivable, meaning we made a sale and people owe us money from that sale, we did not make a sale. We have investments that are earning interest, and so we're going to receive interest. We're going to receive the cash from that in the future. But because of the revenue recognition principle, I can't recognize that revenue in 2021. I have to recognize that revenue in 2020 because I earned that revenue in 2020, even though I didn't receive the cash in 2020. Okay? So then January 10th, we did receive the money. So in 2021, we received $2,000 from the interest that we earned from December 10th to January 10th. So spanning 2 years here, spanning 2 accounting periods. So what would the journal entry be? Pause. Okay. This is a tough one. All right. Remember, we're receiving cash. So, you have to first think in terms of what's happening here. We're getting the cash, so our cash is going up. And then the other thing that's happening is we're earning revenue. We earned $600 worth of revenue for January 1st through January 10th. For the year 2021, we've earned $600 worth of revenue. For 2020, we earned $1,400 worth of revenue. All right. Just like we would credit accounts receivable for when a company paid us money that they owed us, it's the same thing here. We're crediting interest receivable. They no longer owe us that $1,400. We've earned $600 worth of revenue, and then we're debiting cash for $2,000. Okay, so now it's the other side of it. We borrowed money and we've incurred interest expense as a result of that borrowed money, but we haven't paid that. We're not going to pay that interest until the following year. However, because of the matching principle, we need to account for that expense during the accounting period in which it was incurred. All right, the company has a bank loan and has incurred but not recorded interest expense of $2,000 for the year ended December 31st, 2020. The company must pay that interest on January 7th, 2021. Record the adjusting entry for 12/31/20. Pause. Okay, so we've incurred $2,000 worth of interest expense. We're going to pay it off later. So when we owe somebody money, that's called a payable, and then interest expense. So it's just a debit to interest expense and a credit to interest payable. All right, I know these are new accounts for you, so it's just interest payable is the same thing as accounts payable. It's just specific to interest, and this is just another expense. It's just an expense specific to interest. So then on January 7th, we record the entry for the payment of interest of $2,250. Pause. Okay, so we're paying money, all right? And just like in the last problem, we were receiving the interest, so we debited cash. And in this instance, since we're paying money, we need to credit cash. The other thing that we need to do is it looks like the interest was $2,250. $2,000 was from 2020, so that additional $250 was from 2021. So we need to recognize that interest expense of $250 for the year 2021. And then we no longer owe that $2,000, so we need to debit that interest payable for $2,000 and then like I said earlier, we go ahead and credit cash for $22.50. Boom. Moving on. Okay, another depreciation problem. Every single adjusting entry for depreciation is going to have the exact same debit and the exact same credit. Go ahead and pause here. Okay, so depreciation on the company's equipment for 2020 is $16,000. Record the adjusting entry for the end of the year. So once again, this is just a debit to depreciation expense and a credit to accumulated depreciation. All right. So here's another prepaid journal entry. A company spent $96,000 on prepaid insurance to cover them for the next year. What is the journal entry? Pause. Okay. So you should get this. This is on the last test. It's a debit to prepaid insurance and a credit to cash. Remember, prepaid insurance is an asset, and we expense it over the life of that asset. And then at the end of the month, we need to account for how much of that prepaid insurance was used. All right. And so pause here. You need to do a quick calculation. Okay. So 96,000 divided by 12 is $8,000 per year. And so we no longer have $96,000 worth of prepaid insurance because we've used up 1 month's worth of prepaid insurance. So this was originally a debit to prepaid insurance and then a credit to prepaid insurance for $8,000. And then once again, we debit insurance expense. All right. So remember what is the adjusting entry and what is not the adjusting entry. This is just a normal journal entry. Adjusting entries are used at the end of the accounting period to update our books as to how much of an expense we've used up or how much of a revenue that we've earned. And remember, I don't have to, this is prompted by a transaction, right? I sent money, and so I need to journalize that. This is not prompted by a transaction. This is prompted by the end of the month and having to update our books. So that's what adjusting entries are. It's updating our books to reflect properly our expenses and our revenues. As Ms. Cook would say, accrual accounting. All right, here we go. Moving on. December 31st. Salary expenses of $2,700 have been incurred but are not paid as of December 31st, 2019. So people have worked for us, but we're not going to pay them until next year. But we still need to recognize the expense for this year. Pause. All right, it's a debit to salaries expense and a credit to salaries payable. Recognizing the expense in 2019 to reflect accurately the number of hours that were worked in 2019, and then also putting on the books that we owe $2,700 worth of salaries to be paid in the following year. So then on January 7th, it's payday, and we pay $3,500, and so that's for the time period 12/24 to 1/7. So first thing I would ask myself, is cash coming in or is cash going out? And then, do I have another expense? Do I still have the payable? I'm going to go ahead and pause here. Okay. So it's a credit to cash because we're paying our employees. We no longer owe the $2,700 from the payable that we set up last year. And then we have to expense for the amount of salaries that have been incurred during this year. Damn supplies ones. Okay, the supplies account had a debit balance at the end of last year of $325, or the beginning of this year. And then we bought $3,480 more. And then we had $383 left. What is the adjusting entry for the end of this year to update our books to show how much of our supplies we used during the year? I'm going to pause here. Like I said before, this is where I would use a T account, starting with my beginning balance, adding how much we purchased during the year, and then accounting for how much was left over. So once again, what we started with plus how much we bought minus X, which is how much we used, equals our ending balance. And so if you solve for X, you would have gotten 3,422. And so once again, that's an asset, moving from an asset to an expense. So subtraction from asset, addition to expense. A company receives $75,000 cash in advance for work to be performed over the next year. What is this journal entry to record this? You should know this. Pause. Debit to cash for $75,000 and a credit to unearned revenue. And then at the end of the year, 1/3 of that $75,000 cash received in advance of this period is performed. So we just need to update our books. We need to update our books to account for how much of the revenue is now earned. Pause. So 1/3 of 75,000 is 25,000. So it's a debit to unearned revenue for 25,000 and then a credit to revenue. So what are we saying here? We're saying during this year, we've earned $25,000 worth of revenue, and we still have $50,000 worth of unearned revenue to earn in the future. The remaining balance in my unearned revenue account is $50,000 because remember, unearned revenue is a liability which gets increased with a credit and decreased with a debit. So my ending unearned revenue balance is $50,000. Wage expense, same as salaries expense. Those two are interchangeable. So people have worked for us, but we're not going to pay them till next year. Pause. All right, so debit to salaries expense, credit to salaries payable. If you would have put wages expense, it would make no difference. And then this is where it gets harder. Remember, this is the adjusting entry, and then this is the payment that's based off of that adjusting entry. So then on January 7th, we paid $13,500 for that 2-week span. Pause. And once again, that's a debit to the difference because, if the salaries were $13,500 and $10,700 were from last year, that means $2,800 must be from this year. We no longer owe that $10,700, so I'm subtracting from the liability. That is a debit to the liabilities subtraction. I owe $10,700 less, and that is incorrect. That is a typo right there. Typo. Just making sure you're paying attention. That is a big fat typo right there. Look at that typo. My gosh, that is really bad. That should be cash. That should not be revenue. So let's fix that right now. That should be cash. Just making sure you're all paying attention. All right. Okay. Oh, man. Okay. Company has 15 employees who earn a total of $1,830 in salaries each working day. They're paid each Monday for their work in the 5-day work week ending on the previous Friday. Assume that December 31st is a Tuesday and all 15 employees work the first 2 days of that week. They will be paid salaries for 5 full days on Monday, January 6, 2021. So what's the adjusting entry on December 31st? And then what's the entry for the payment? So first, we're just going to account for the salaries that were earned during 2020. All right. Once again, they make $18.30 per day in total, not each. And that'd be some sweet cash. But it's $18.30 in total for all 15 employees. I'm gonna pause here. Okay, so that's a debit to salaries expense for $36.60, which is $18.30 times 2. That represents Monday and Tuesday. We owe them $36.60. What we're going to pay the following Monday. I'll give you a second to do the January 6th journal entry. Okay, so that's a debit to salaries expense for $54.90. That's the 3 days, Wednesday, Thursday, Friday. Closing out the payable, they no longer owe that $36.60 anymore. And then a credit to cash because, 1,830 times 5 days is 9,150. Okay, a tenant in your building that you own paid 6 months worth rent in advance, worth $12,000 in advance on November 1st. So they paid today for the rent that's going to cover them for November, December, January, February, March, and April. All right, so from you, the person who owns the building, what does your journal entry look like for that transaction? Pause. Sorry. So that would be a debit to cash. We've got cash, but we haven't done it. Like we haven't provided anything for them. We haven't earned anything, right? As of November 1st, we haven't earned any of that $12,000 yet. So that is unearned rent. Unearned rent is just the more specific form of unearned revenue, also a liability. So then at the end of the month, you need to adjust for the amount of rent that was earned during the month of November. Pause. Okay, so 6 months, $12,000, that's $2,000 a month. So they no longer have $12,000 worth of unearned rent. They only have $10,000 worth of unearned rents because we had to subtract $2,000 from that. That's a debit to the liability is a subtraction, and then rent earned is the same as revenue. What you're starting to see is we started with just revenue and expense, and now we're getting into more specific forms of revenue. So that rent earned is a revenue. So we've earned $2,000 worth of revenue, and then we subtracted $2,000 from unearned rent. And that's it. So I hope that was helpful. Thank you to Ms. Cook for working through that. Your homework is for the following class is to do some depreciation stuff. And there's 3 different forms of depreciation. It's straight line, units of production, and double declining balance method. They are not super hard to work through. I'm confident that with some work on your end, you can figure it out. I have great slides that cover that. If you want to poke through those, the textbook has great examples of the different forms of depreciation. And then the other thing is I made a video for the Chapter 3 homework. So I can walk you through step by step on how to do those depreciation problems. But you absolutely can figure it out. Just going to take a little bit of work on your end, and you should have some time at the end of class to do that. All right. Thanks for being cooperative with Ms. Cook here. I appreciate it, and I hope to see you very, very, very soon. Thanks, everybody.